In this video, we're going to go over one of my favorite option trades, and that is selling the Strangle. Now, the reason this is one of my favorite trades is that it's really easy to implement, it's easy to manage, and it has a very high probability of success. Now, for those of you that are already on the Tasty Trade platform, this will probably be a familiar option trade for you. It's one of their go-to trades, and for good reason. It does work. So, if this sounds good, stick around, and we'll see you after the intro. So if you see my previous videos, you know that I like to teach by example. So that's exactly what we're going to do in this one. We're going to look at ticker CNQ, and I'm going to go step by step through a trade that I put on, and also what my plan is to manage this trade going forward. So you probably noticed that this isn't Tasty Trade, this is Thinkorswim, and I'll post a link up here to a previous video that I did kind of explaining why I prefer to use the charts on Thinkorswim, and I prefer the Tasty Trade platform for entering the option trade. So I'm not going to go into all that detail on why that is in this video, but if you want to know why I use both platforms, just check out that other video that I did on my review of both Thinkorswim and Tasty Trade, and that'll show you all the details on what my preferences are. So again, here we got CNQ. I've already drawn in the trend lines, so you can kind of see, support has very consistently been around the $60 level, and resistance, really strong resistance around $67.50. So we know where our support and resistance are, and what's really nice is the stock is trading right in the middle of that range right now. So a perfect time for putting on a short strangle trade. The other thing you want to look for before you put on this type of trade is you want a stock that has a relatively high implied volatility. So you can see over here the implied volatility rank is currently at 33%. So I like to look at stocks that are ideally above 30%, or at least around 25% or higher. That just helps to ensure that you're collecting enough premium to make it worth the risk that you're taking on by putting on this strategy. Okay, so now that we know what our support and resistance levels are, we know that the implied volatility is high enough that it is a stock that we want to look at for this trade. Let's go over to the Tasty Trade platform. So here we can see the option prices for CNQ. And if you note, I got the February 16th options are the ones I'm looking at. So the reason for that is, again, if you're following this strategy, you want to typically go out about at least 45 days in time. And you want to remember to manage this trade no later than 21 days before expiration. So by going to February 16th, that gives us 57 days to expiry, which really close to that 45. So I'm good with that. Now, as far as strike prices, the way I set this trade up is I typically want to sell somewhere around a 20 delta, both on the put and on the call. So let's look at the calls first. We can see our delta over in this column. So our choices are either basically a 16 or a 25 delta. In this case, I would prefer to go with the 16 delta. It just gives us a little bit of higher probability of this trade working out. So we collect 55 cents for putting on that trade. And then on the put side, again, we look at our deltas. Our choices are either 16 or 26. Now, typically I would probably go with the 16. So that gives us about $1.30 in credit. Now that's fine. My kind of general rule of thumb is I want to collect at least $1 when I put these types of trades on. And then you want to manage it anywhere from around 25 to 50% profit. However, in this case, because of the way the chart looks, and honestly also because of the way the price of oil has been trading, I just have a slightly bullish undertone to this trade. So what I'm going to do, instead of selling the 16 delta put, I'm going to sell the 25. Now, again, my reason for doing that is I am slightly bullish on CNQ. So if you're not, don't follow me on this, go with the 16. My other reason is I am perfectly fine getting assigned this stock at $60 if I had to as a worst case scenario. So if this trade doesn't work out and the stock does pull back, I'm okay getting assigned at 60. Maybe let's just take a quick look at why that is again. So if we know, remember at $60, we have this really strong support, but we also have the 200-day moving average. So I'm comfortable that if this stock were to come back down to 60, or even if it broke down below 60, I'd be comfortable purchasing the stock at that price. So now what that does, it allows us to collect a little more in premium. Now we're collecting $1.77. So it moves our break-even points a little higher above the call and a little lower below the put. And what I really like about Tasty Trade is it shows you this green column here, this green bar, and it basically tells you where your break-even points are, both on the call and the put side. I mean, in this case, it's real easy to calculate. It's basically 72.50 plus the premium collected of 177. That gives you your break even on the call side or on the upside. And similarly on the put side, you take $60 minus the 177 that you collected. That gives you your break even on the downside. But anyway, just a really nice feature that this kind of visually shows you where your break even points are. Now, when you're putting these trades on, there's some really useful information down here in the Tasty Trade platform. So you can see that with this trade, it's telling us we have a probability of profit of about 70%. So that's really good. I like to have at least higher than 65%, but obviously the higher the better. It also gives you the delta for the overall trade. Now remember, I said I was slightly bullish on this. So ending up with a 9 delta kind of fits that criteria. And then it also gives you your max profit, which for $1.77 credit, obviously, is $177. But one thing really important to note, if you haven't done this type of trade before, when you're selling a short straddle, you have unlimited loss. This is what we call an undefined risk strategy. There is no limit to the amount of risk that you're taking with this type of trade. So it shows as infinity. So we'll get to that here in a minute, but it's really important. This isn't a trade where you can just set the trade and forget about it. This is a trade you need to monitor, and you might need to actively manage if it starts getting, if it starts going against you. Now, one thing I'll point out before we get back to the chart again, if I had gone with the 16 delta as I initially put on, look what that does to some of these numbers. It increases your probability of profit now to 76%. And that makes perfect sense. I mean, our strikes are moving farther out, so we have a higher probability of profit. It also makes us pretty much delta neutral. So by doing this, we're basically saying we're not bullish or bearish. We think the stock's just going to go sideways. Now, we're bringing in less credit, so our max profit went down. Our max loss is still infinite. It's still an undefined risk strategy. So you can play around with some of these strike prices and see how it affects your overall delta and probability of profit. So again, for the purpose of this, I'm going to leave it here. This is the actual trade that I did put on. And so now that we understand all that, we can go back to the chart and look at how do you manage this trade. Okay, so first things first, when we get to the chart, let's draw our lines on. So we have our trend lines of support and resistance, but let's also draw the lines of where we sold these calls and puts. So for the put, it's easy. We sold it at $60, so it lines up already with that support line. For the call, we sold it at $72.50. So let's draw a line here, right around $72.50. Okay, and you can make that whatever color you want. But now we know where our short strikes are. And if you really want, I mean, you could even draw your break-even lines. I usually would do that. In this case, it's really easy to figure out your break-even. But if you want to draw your break-even lines, you can do that also. Now, ideally, what we want is we want the stock price to stay in between our short put and our short call and let time decay do its thing. So if over the next week or two, the stock price pretty much just stays where it is, or actually even if it moves up a little bit, time decay is going to reduce the value of the options that we sold, and we'll be able to buy them back cheaper, which is basically what you want to do in this strategy. So with the $1.77 that I collected, I'd be looking to take profits. If I could buy this thing back for anywhere from, let's say $1 down to 77 cents or so. That'll give me a pretty nice profit on this trade. So you want to have your target. I mean, you can even set you could even set up a limit order with whatever your profit target is, and that way, if it hits that, it'll just automatically sell, and you can book your profit. So that's the easy part. But what happens if the stock price starts moving against you? What if the trade isn't really working out? Well, let's look at that side of it. So let's say, again, I was slightly bullish on this. So I'm a lot more aggressive on my put than I am on my call. Normally, when you put these on, you'd pretty much be centered. So let's look at the put side. What if the stock price starts to fall? So what if my bullish thesis is wrong and the stock price starts to fall and it starts testing this 200-day moving average, or it starts testing this support line again, which, could very well happen. Well, what you want to do at that point is you'd want to collect some additional premium on your call to offset the downside risk if the stock were to break through and continue falling. So what I mean by that is that the call that we sold is all the way up here at $72.50. So if this stock comes down again and starts testing these levels, what I would do is I would roll down the $72.50 call. I would roll it down somewhere to this resistance line. So, somewhere like around the $67.50 level. When you roll it down, and this is assuming that this happens like in the next week or so. So we're still somewhere near that 45 days to expiry. I wouldn't change the expiry date. I would leave the expiry as it is. All I would do is roll down the strike price. What that's going to do is it's going to give you additional credit on top of what you already collected, basically pushing your break-even point lower than what it was below your put. Okay, so that's what you want to do to limit your risk. Now, let's say the stock breaks below here and it just continues falling. Well, then you're going to have to get a lot more aggressive with your rolls. So instead of, maybe you already did roll to the 67.50. At that point, if the stock breaks through and continues lower, you're going to have to roll this down, maybe all the way to the 50-day moving average, maybe somewhere around the 64.50 level. You're going to want to try and collect as much premium as you can to offset that downside risk. At this point, you're no longer so much concerned with making a profit. At this point, you're trying to manage the position and avoid taking a loss. So you're trying to make sure that you're staying at that break even at this point. So those are still fairly simple. Now, what if the stock just really starts to implode? Okay, the stock's just fallen. It's fallen off a cliff. What you can do at that point is you can roll your call all the way down to your put. So in other words, you have a $60 short put. You can roll that call all the way down to $60. So you're short the 60 call and the 60 put. That'll give you the most credit that you can collect. And basically you turned your strangle into a straddle. So hopefully at that point, the amount of credit that you've now collected will offset any downside risk of where the stock price happens to be. And if you really, really need to get extreme, let's say that's still not enough. You're still not collecting enough credit. You're still at a loss. What you can do is you can actually go inverted. So what that means is you would roll this call lower than what your put is. So for example, you would leave your put at, you're short the $60 put. You might go down to like the $58 call. So you'd be short the 58. Again, that's going to bring you even more credit and, help offset any losses that you're taking on that stock. Now, one thing to keep in mind is when you're going inverted, you want to make sure that the total premium you collected is more than the width of your now inverted short call and put. So for example, if you say you're going to $58, if you sell the $58 call, so from 58 to your short put is of $60, that's a $2 difference. You want to make sure the total premium you collected is more than $2. Obviously it will be because we already collected $1.77 right at the start of this thing. So by doing all these additional rolls, you'd be well over that $2. So you could realistically, probably you could even go down to the 56 or so, depending on how much premium you collected. But you just want to make sure you collected more than what that inverted width is now on your new strikes. Now, one caveat to all of this is basically in all of these examples, I was saying to keep your expiry date the same and just roll the strike price. Well, that's true if you are still around that 45 days. But if this is starting to happen as you're getting closer to that 21 days to expiration, well, now you have one more tool that you can use, and that is rolling out to a future month. So these were the February expiration. You can roll out to March. And you would do that both on the put and on the call. And again, that'll give you additional premium to help offset any possible losses. That's how you manage losses in this type of trade. Like I said, the gains are really easy to manage. The gains, just basically work themselves out. All it is time decay. You hold for a week, hold for a couple weeks, and buy it back cheaper. So those are really easy. Managing the losers, it really isn't that difficult as long as you follow these steps. And the worst thing you can do is panic as it starts to go down past one of your strikes. It's really simple. If you just roll the untested side towards the tested side to collect that additional premium, it's very rare that you would have a losing trade on one of these. All right, so that's really all there is to this type of trade of selling a strangle. Hopefully that was helpful. Hopefully you learned something. If you're enjoying this content, please hit those like and subscribe buttons, and we'll see you next time.